Good day, everyone, and welcome to Equilibrium's quarterly bulletin for the third quarter of 2025. My name is Carl Chetty, and I'm a senior portfolio manager and head of investment proposition at Equilibrium Investment Management. It's my great joy to be your host today. Thank you for taking the time to join us and for your continued support of our investment solutions. We have an exciting agenda ahead, but before we delve into the session, let me first address a few housekeeping matters. We've applied for CPD points and expect to receive confirmation from the FPI in the coming weeks. It's important to please watch the full session and add your ID number to the CPD section so that we can verify your attendance. You may also view this event on this platform at any time until the end of September and still receive your CPD points. Our event platform automatically emails you your CPD certificate as soon as you've watched the full session. Lastly, please feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. Okay, let's kick off this quarter's session. The global economy is currently being driven and molded by a complex interplay of trade wars, real wars, divergent monetary and fiscal policy, rising government debt levels, and waning US exceptionalism. These uncertainties are clouding the outlook for global economic growth and translating into heightened volatility and more frequent V-shaped price movements in global financial markets. Although the risks to global economic growth are elevated, there are still many pockets of opportunity and good reasons to remain optimistic and invested in risk assets. First up is our chief economist, Sanisha Pakarasamy, and economist Chiamo Masike, who will talk about anchoring economic growth in a geopolitical storm. Sanisha and Chiamo, we look forward to your valuable insights. Over to you.
Thank you, Carl, and good day, everyone. We are past the first half of the year, but the fog has not lifted. The world is still grappling with trade policy flip-flops, keeping businesses, investors, and households on edge. At this point, uncertainty is not just lingering, but it is evolving. And we will unpack what that means for global momentum with Sanisha. I want us to first unpack the growth impact. How is this evolving uncertainty affecting global economic growth prospects?
Well, thanks, Siamo. I think we can say that uncertainty is having quite a negative implication for economic activity across the globe, especially when we start thinking about tariff policy, the magnitude and the duration of these tariffs. Now, the International Monetary Fund has basically suggested that tariffs in themselves can be negative for growth. But the unpredictability of that tariff policy can be even more damaging for growth. So think about it from the perspective of a business. Now, a business has a lot of uncertainty around the consumers that will buy from them, and of course the suppliers and the health of their suppliers. And so they might actually bring in fixed investment and not really hire as many workers. And the same thing applies for a typical consumer in the global economy, roiled into the pandemic, and then of course more recently a cost of living crisis that came out from the two wars. Now they're going to face a lot of uncertainty around tariffs and what that means at the end of the day for the money in their pockets. And so from that perspective, businesses and consumers will be pulling back on spending, and that's quite negative for growth. Now, the IMF has said that if you just look at the uncertainty related to tariffs, that could pull off about 0.5% from baseline GDP and the level of growth this year, and about 0.8% for next year. So quite a big, meaningful impact. And of course, if we look across to the World Economic Prospects report from the World Bank, here they're basically looking at a growth rate of about 2.3% for this year. So that's quite weak. It's probably the lowest growth rate that we've seen in about 17 years outside of the recessions. And if we have to take into account what the World Bank's numbers are for the next couple of years, the 2020s are going to be the lowest decade of growth that we've experienced since the 1960s. The World Bank, since the beginning of the year, have downgraded about 70 of the economies that they look at, and about 60% of the economies are now expected to experience a slower rate of growth than we did see in 2024. So this uncertainty is really roiling economic growth in quite a big way.
I think, as you've just mentioned, uncertainty alone has a massive negative implication. And we know this is partly due to whipsawing tariffs. Since the sweeping duties on Liberation Day, we had the announcement of the 90-day pause, then product-specific tariffs, some country-specific deals already struck, and the 1 August deadline extension. This has resulted in changes to the effective tariff rate. Can you take us through these changes and what is the market baking in at this point?
So I think it's quite difficult to really get a firm handle on what the market is baking in for tariffs. But I think safe to say that the baseline tariff of 10% that's been applied to all of the US goods imports will probably stay. The idea behind those tariffs was to ensure a more level playing ground in terms of trade deficits with the rest of the world, and also to start bringing back manufacturing to the US economy. On top of that, I think we will probably see the tariffs on Canada and Mexico prevailing because these have to do with national security. They want to limit drug trafficking into the country as well as limit the illegal immigrations across the border. However, we have seen some sanity prevail. And so when we look at areas where the US is still quite reliant, so yeah, think about the rare earth minerals that are produced by China. When they wanted to curb those exports, suddenly we had quite a big de-escalation in the tariff debacle there. And the same thing applies really with electronics. Now, if we think about areas that were quite hard hit, autos, steel, aluminium, the jury is still out as to whether or not we'll get quotas applied that will actually soften the blow of those tariffs. And I think ultimately there's still quite a lot of uncertainty around additional tariffs. So if we think about the European Union, they could potentially use this as a trump card and say, we can actually apply digital services taxes if you apply sector-specific tariffs on us. And this is quite interesting because up until this point, we've really only concentrated on tariffs in the goods department of global GDP rather than services. And we know that the US economy actually runs a trade surplus on services with a number of countries. And so this could be an angle that the rest of the world then takes. The other issue we don't have a lot of clarity on is on transshipments. So take Vietnam and the deal that they brokered with the US more recently. And the US came down quite strongly on Vietnam and said, if you are importing goods from China and then sending it straight on to the US, we would probably have to levy those goods. But again, it's very difficult to get an idea of the quantum of those transshipments. And so there's a lot of uncertainty around there. But I think ultimately what the market is pricing in is something that's a little bit softer than Liberation Day tariffs, but ultimately a lot higher than what we've seen in recent history. So this is going to have a negative impact on growth, as we've said, but it will also have a negative impact on inflation. And we've seen in the US economy already that the consumer price inflation is starting to now pick up on the back of these more onerous tariffs.
You brought up an interesting thought that goods have been the target of the tariffs, but there is still uncertainty about, for example, services, which could potentially exacerbate the disruptions. With what we know now, the ongoing bilateral negotiations, and considering the telco pattern, so Trump always chickens out, how could economic growth evolve?
It's interesting to kind of get a bigger range of growth forecasts from here. And again, we'll look to the World Bank's June report, where they basically look at a baseline growth number of 2.3%, but then look at an upside scenario and a downside surprise. Now, I think we can, fundamentally say that the risks to the downside are far greater at this point in time. And what the World Bank has then colored in for that picture on a downside scenario is to say that there's more policy uncertainty, investment is held back, we have financial conditions that deteriorate, potentially more geopolitical fragmentation, even the incidence of natural disasters having a bigger impact on growth. And in that kind of world, we would probably see growth being about 0.5 percentage points weaker than the baseline for this year, and about 0.4 percentage points lower for next year. So if you think about that baseline growth number of 2.3, and if you take off the 0.5, we're sitting with the potential growth rate in a downside scenario of 1.8. That would actually put the global economy into an outright recession. Now, on the upside, there is potential for a better than expected economic growth outlook, and the World Bank says that would probably come through from more fiscal spending, the fact that tariffs may actually be a little bit lower, so half of the baseline, which is about 14%. The baseline plus 10 percentage points is essentially what's baked into the negative scenario. So you can see that gap in the range there. And then in the upside surprise, they also talk about productivity enhancements coming through from AI and technology. And in that case, you'd get about 0.1 percentage points added to growth for this year and about 0.3 percentage points added to next year. But you can see in terms of that range, the downside surprises are more hefty on the downside rather than the upside surprises from here.
Yeah, I think with what you just said, that potential upsides are there, but downsides are more at play here. With that said, how are recession fears playing out?
That being said, that we do think that downside risks hold a bigger weight. Even with that in play, we do believe that the risk of a recession has come back quite significantly. Now, you might ask why, and I think part of that is because of just general tariff fatigue, and the other point that you made about taco. So I think investors, not really baking in the full extent of what Trump is proposing, as you might, chicken out from there on those policies. And it doesn't really matter which metrics you look at, whether it's market-based sentiment indicators or whether you actually go out and survey respondents. But across the board, we are seeing a lower probability of recession being penciled in. So if you take the New York Fed recession indicator, which is an analysis of the yield curve, taking a longer yield bond, the 10-year, less your 3-month yield, so that will give you a spread, and then converting that into a probability, we're now sitting with a probability of a recession that's about 29%. This was at 70% in April after the Liberation Day tariffs were announced. Again, if you look at the market indicators and we look at the Bank of America survey that looks at your fund managers across the globe, again, in April, half of them were saying that there's quite a big probability of getting a hard landing in the US economy in the next 12 months. This is now rolled back to about 1 in 10. So again, you can see that across the board, the market is assuming a lower risk of recession, even though this year is not going to be great in terms of GDP growth.
Okay, so chances of a recession seem to be very slim. Despite this, though, there's a lot of talk about US exceptionalism being at risk. Can you unpack US exceptionalism a bit?
Sure, I think it's quite important to kind of define what US exceptionalism is. And we like to bucket this into 4 approaches. So the first is really from an economic stance, because we know that, the US contributes about a quarter of global GDP. Secondly, we would also then look to the financial angle. And so we know here that the dollar has been the predominant reserve currency in the world for a number of decades. Thirdly, if we look at it from a geopolitical perspective, the military force and defense system in the US is quite a formidable one. They do contribute a lot to NATO spending and in terms of the US's influence in the world at global organizations, such as the World Trade Organization. And then lastly, from a technological perspective, the US has done a lot of that hard work in terms of spending on research and development and has built an ecosystem that's quite conducive for corporate profitability. Now we're moving into a more multipolar world. So we do believe that the US will still have influence, but we do believe that their leadership will now be shared across those other economies when it comes to things like the economy, when it comes to things like geopolitics or the financial system. I think where the US can still be a key leader is in the area of technology. And that's because they've done so much research and development spend, unlike, the UK or Germany. This also doesn't really take away from the argument that China is, of course, becoming quite a big rival in that space. But I think, the US in this area can still be a key leader in the global economy.
So given that 3 of the 4 metrics that you ascribe US exceptionalism to can be shared, what does this mean for the United States dollar?
I think it's going to be very difficult for the world to move away from the dollar very quickly. Just to sketch that out a bit, if we had to look at all of the foreign denominated debt in the global economy, about half of it is sitting in the US dollar. Half of global export invoicing is done in the dollar. About 57% of foreign exchange reserves are sitting in the dollar, and almost 90% of FX transactions across the globe
are
conducted in the dollar. And so it's very difficult, for economies to actually move away from that mode of transaction. Also, if you try to think about who are the natural contenders, and here we can, focus on a chart we put together, looking at what the criteria are for a currency to become the world's reserve currency. We know that the dollar ticks a lot of those boxes, and you can see a lot of green on the chart for the US dollar. However, if you look to the euro, they fall short when it comes to the size of the eurobond market, which is about less than half of the US Treasury market. If we go to the Japanese yen or maybe even the Swiss franc, even though these currencies do act as safe haven assets at times, it's a very small market, so there's not going to be enough currency for these foreign transactions to go through. And then lastly, if we think about the renminbi, China still has severe capital controls in place, which we know investors don't like, and not really a freely floating currency that's easily convertible. Maybe so in Asia, but not really the rest of the world just yet.
So I hear where all the other currencies are falling short. What about gold? We also saw recently that Basel III recognized gold as a tier 1 asset.
That's a good question. So, gold has really performed well as a safe haven bet as risk appetite has waned in the last while. But again, I think for the reason that it is a store of value rather than a means of transaction. And I think it will hit up against the same constraints as a Japanese yen or Swiss franc, which means that there's just not enough gold for those transactions to take place.
We know there's also been a lot of gold purchases by central banks recently, which has helped gold prices. Do you think there is further support for gold?
Yes, I think we can make quite a strong argument that emerging market central banks will continue to mop up gold in favor of the US dollar for their reserve holdings. And I think we saw a fundamental shift in 2022 when Russia invaded Ukraine, and we saw that America came down quite hard on Russia and froze a lot of their FX reserves that were denominated in dollar terms. And I think, emerging markets got quite nervous about that because if their relations with the US soured at any point, the same could happen to them. And so, places like China would probably prefer to have, gold bullion that they can store in their own country. And, to make that point about China, officially, they probably, hold about 2,200 tons. Unofficially, Bloomberg has suggested they probably hold closer to 5,000 tons. So this comes a long way in explaining why gold has actually run as hard as it has. But even if China has to get to the global average, which is about, a fifth of global central banks' holdings are now in gold rather than any other currency. If China had to get there, they're currently at about 5%. So even if that number had to just double and not get to that 20%, it does still mean that gold has further to run in the cycle.
Let's talk about the other elephant in the room, US fiscal. The one big beautiful bill, which prioritizes tax cuts and increased spending in certain areas, while reducing social welfare expenditure, was passed in July. And a big concern around the act is the negative debt impact. It's estimated to add more than 3.2 trillion US dollars to the debt over a 10-year period, which is quite significant.
To be fair, Tsiamo, the debt issue is not just a US issue. And so if we look at the typical country belonging to the OECD, the Organization for Economic Cooperation and Development, they've got an interest bill as a share of GDP that has basically gone up from 3% in 2021 to about 4% in 2024. Now, that might not seem like a big shift, but it's the highest that it's been in over 20 years. And it does also imply that governments today are now spending more on servicing debt rather than spending on things like the police force or defense or even housing. And that has a significant repercussion for structural reform in a number of markets. But I think what you're alluding to here is just around policy unpredictability, less flexibility around fiscal and monetary policy in this stance. And in terms of that big, beautiful bull act, if we continue on this trajectory, we could end up with a debt to GDP ratio in the US that gets to about 140% as a share of GDP by 2050. Now, this is problematic because currently investors are looking for a higher yield to compensate them for risk when they invest in US securities. And that means that the yield could go even higher in the future. But there's also quite an interesting interplay between fiscal and monetary policy at the moment. And so, there's a bit of what we call fiscal dominance, that implies that fiscal policy is running quite loose, and that prevents central banks from cutting by too much because they have to be quite aware of the inflationary impact of those fiscal policies. But then more recently, we've also had some indication around potential political interference in some central banks, like the US Federal Reserve. And I think markets are becoming very nervous around the credibility of the Fed to be able to maintain price stability in this current environment.
Speaking of that United States Federal Reserve, we know the chair, Jerome Powell, his term is coming to an end next year. And you touched on the political influence. What can we expect from here?
Well, Powell steps down in May of 2026, and what we can say up until this point, that him together with the other FOMC members, the Federal Open Market Committee members, have been quite circumspect about inflation risks, saying that they need to be data dependent, and really having quite a cautious outlook on interest rate policy, suggesting that maybe we get another 2 cuts from here because of those inflation risks. What the market has cottoned onto is the potential for him to be replaced by someone who has a far more dovish approach to interest rate policy in spite of these inflation risks. And I think this is where market participants are becoming quite wary around the credibility of the Fed and their ability to maintain prices at a stable level in this era of higher protectionist policies.
Let us turn to South Africa. You mentioned that fiscal woes are not unique to the United States, and South Africa has its fair share of challenges. We've experienced 3 consecutive budgets with upward revisions to the debt to GDP ratio. This is unsustainable, especially considering that SA's debt to GDP more than tripled since 2008, from 24% to above 75%. While government is pursuing fiscal consolidation and targeting a primary surplus, this does tighten spending and limits fiscal support for growth. At the same time, trade disruptions weigh on exports, and fixed investment remains weak, dampening near-term growth prospects. Some support is expected from consumers, aided by lower inflation, declining interest rates, and two-pot withdrawals, but pressure from bracket creep persists. At this point, medium-term growth hinges on structural reforms, which are driven by Operation Vulindlela, a body operating between the National Treasury and the Office of the Presidency. While post-GNU reform euphoria has faded, sentiment is improving, and reform should play a bigger role over time. Which areas of reform are you seeing movement in that could support medium-term growth?
We know that, during phase 1 of Operation Vulindlela, quite a lot of effort was put into areas of energy, logistics, water, visa, digital spectrum, and now they're expanding this to phase 2. Some of the projects, of course, that they did in phase 1 will be continued. So if we think about energy, quite a lot of effort was put behind restoring generation. Now they're looking at things like distribution networks and expanding on the transmission grid. If we think about water, quite a lot of effort went into reinstating the monitoring systems there. Now they'll be looking at improving private sector participation and getting a regulatory body on board. In logistics, we saw, quite a big portion of legislation coming through for the transport sector to enable more private sector participation to come through. I think we'll be seeing a lot more PPPs formulating in the next couple of years in things like ports or even just the railway network in general. And we'll probably also have a transport economic regulator that's put into place. If we look at the visa reforms, again, a lot of work was done under phase 1, but I think they'll really just be expanding on the remote worker visa system, as well as the points-based system for skilled workers. And then, of course, moving now into the era of phase 2, and what they're trying to achieve here is a big overhaul of local municipalities, which has been quite a choke point for many businesses in South Africa as they have failed to deliver on services. And so now they're looking at things like a trading system for water and electricity, professionalizing services, and really just improving the governance and overall financial situation of municipalities in South Africa. The second element of phase 2 focuses on the spatial issues. So this is bringing people closer to work opportunities, making sure that we have a fully functioning passenger railway system, ensuring that we can eradicate the backlog on title deeds for affordable housing. And then lastly, focusing on the digital aspect, this is really just enhancing digital payments. And I think this can be a complete game changer for township economies, as an example.
Yeah. But I think, as always, the challenge isn't the reform plans themselves, but rather the political will to implement. The GNU is currently fragile because of tensions between the ANC and the DA. While we expect the coalition to continue this year, we do not expect a lot of policy momentum. The outcome of the DA's leadership contest in 2026 and the ANC's one in 2027 will shape the policy and growth trajectory. The ANC battle may become more complicated given allegations on one of the frontrunners. Further out, we have the national elections, and the outcome of that, whether center-left or center-right, will matter a great deal. But for now, what are some of the things that can make us smile and be hopeful?
So we've mentioned quite a lot of the structural reform efforts that will generate a higher economic growth profile in the medium term. But maybe let's talk about, inflation. Given that this has been a bugbear for much of the global economy in the last while, and South Africa has actually been in quite a fortunate position where we've actually operated closer to the bottom end of our inflation target. I think this is really what's been behind the debate about lowering the inflation target, which we believe is a good thing in the longer term in order to improve purchasing power of consumers, ultimately eradicating poverty over a longer time frame, bringing in those debt servicing costs for government. That's really on the inflation front. I think what's also been aiding that, which is another bright spot in SA, is that we've actually had quite a well-behaved currency in spite of all of these global and local risks that have been playing about. And I think part and parcel of that is that our terms of trade has performed quite well. And part of that has been because gold prices have performed well and oil prices have been relatively subdued, even in light of the Israel-Iranian tensions that broke out earlier on in the year. Add to that, on the growth side of things, we've seen another unit of Medupi coming on stream about 8 months ahead of schedule. This really even lowers the risk of load shedding even more. If you think about growth in general, I think, one of the biggest drawbacks could potentially be the US tariffs if they do slap on the 30% across the board without maybe quotas in place. The bright spot here is that the US actually only accounts for less than 8% of our total exports. And we know that the Reserve Bank in March of this year calculated a few scenarios, one of which was a 25% tariff across the board on SA products that are sent to the US. And in that scenario, it whops off about 0.2 percentage points from growth. It's only really in a scenario where financial conditions sour significantly or the rand, falls out of bed for a prolonged period of time and sentiment really gets dashed in a meaningful way, could that detract about 0.7 percentage points from growth. So I would take that as a bit of a bright spot because we haven't actually seen the rand performing in that way, and financial conditions have, broadly speaking, upheld in this kind of scenario. And then lastly, I think one of the biggest bright spots to be quite happy about is essentially that in October of this year, we might find that South Africa has actually taken off the Financial Action Task Force's grey list. So there were 22 action items of which we've now completed, and the last hurdle is just to show political willingness to implement on those action items and to ensure that there's requisite financing for those crime combating institutions. And even though it may not, bring a massive amount of capital flows into the country, it will still help from a due diligence perspective, lowering costs there, lowering the time delays, and just overall, improving the reputation of South Africa in a global context.
To close off, the fog of uncertainty still hangs, but it's not all grey skies, both globally and locally. While it's not a boom story yet, it's not a bust either. Thank you to the viewers, and thank you, Sanisha, for sharing your insights.
Thank you, Tiamo.
Thank you, Sanisha and Siamo, for helping us make sense of this complex global macroeconomic environment. Although the global economy is not booming just yet, it is certainly not about to go bust either, and there are many great investment opportunities that can be exploited by astute investors. Next up is Zandile Nkwanyana, a portfolio manager at 361 Asset Management. We recently made a meaningful allocation to the 361 BCI SA Equity Fund across our client portfolios. Through a robust and nimble investment process that combines both bottom-up and top-down thinking with rigorous risk management, The team at 361 have delivered an impressive long-term track record of extracting consistent alpha in the South African equity market, and we are excited for the contribution we expect them to make to our client portfolios. Zandile will now share how 361's agile investment process is geared to generate alpha with relatively lower volatility. Thank you, Zandile.
Thank you, Carl. Hi, everyone. My name is Zandile Nkwanyana, and I'm part of the investment team at 361 Asset Management. Thank you to Equilibrium for giving us this opportunity to tell you more about our firm and our approach to managing money. For the next 20 minutes, I'll take you through how our agile investment process helps us to generate alpha with less volatility, a topic that's incredibly relevant in today's unpredictable markets. But first, an introduction to 361. For those of you who may not be familiar with us, we're a boutique asset manager with a track record that spans over 2 decades. Our firm is owner-managed, and our team of 14 dedicated investment professionals is invested right alongside our clients. This alignment of interest is fundamental to how we operate. We currently manage approximately 50 billion rand, meaning that we are still quite small and nimble enough to operate in the local market. We also manage a diverse range of products, including hedge funds and unit trusts. We don't promote one product over another and believe that each has its place in a portfolio. People often ask about our name, 361, so I thought I'd touch on that briefly. It really speaks to our core philosophy. We believe that true excellence lies just beyond expectations. As I'm sure you all know, the circumference of a circle is 360 degrees. We believe in going further when others may believe that something is complete. We go that extra degree. That's what we think really makes a difference. It's this commitment to going further that has been the driving force behind our consistent outperformance over the years. And our approach has been recognized by the industry with awards across our product range. These accolades are a testament to the hard work and dedication of our team. So how do we approach investing, and what makes us different? At its core, our investment process is built on 4 key pillars. Firstly, we have what we call hedge fund DNA. We have one team of analysts that looks for investment opportunities across all of our different products. That means that similar to a long-only manager, we perform rigorous research on ideas that we want to buy. But whereas a long-only manager may exclude a business that they don't want to buy, we go a bit further by performing more in-depth research, as we may be able to profit from this opportunity as a potential short. This gives us deeper insights into the market and more tools to manage risk by really fully understanding both good and bad investments. Secondly, we conduct rigorous bottom-up fundamental research that enables what we call high-conviction stock picking. We focus on the true value and quality of individual companies, not market noise. Thirdly, we are style agnostic. We adapt our portfolios to perform across different market cycles, whether value, growth, or quality is in favor. This flexibility is key to consistent returns over the long term. And finally, we apply a macro overlay to our bottom-up research. By understanding the broader economic environment, we can protect capital during downturns and position our portfolios for upside when the market environment is more favorable. That investment approach has been built to ensure our clients' capital is protected. When it comes to capital preservation, it's not just a principle for us, it's also an outcome of our investment process. And I'll use an example to express this. When many people talk about the merits of investing in the long term, they focus on the risk of missing out on the best days of the market. The chart on this slide shows 3 investment outcomes. The gold line is the Aussie total return over a 20-year period. And the blue line just below that shows that missing the 10 best days during that period would have resulted in about half of the gains. What many people don't discuss is the red line, showing that missing the worst days would have doubled the returns of the index over that same time period. This reflects the value of capital preservation and protecting capital during downturns. Our hedge fund mindset is a key way that we achieve this. By missing some of the landmines which have been on the JSE, our process has enabled us to avoid significant drawdowns and protect our investors' capital. Our process leads to consistent results regardless of the market environment. Here we've shown the volatility in the resources sector over the last 5 years. That includes the period through the pandemic and a very volatile period in interest rates. Despite this elevated volatility and a highly cyclical sector, our fund was able to generate alpha in each of those years, outperforming the benchmark on a consistent basis. And this really summarizes what we aim to achieve through our investment process: consistent outperformance with less risk. Over the last 5 years, our SA equity strategy has outperformed its benchmark 72% of the time. And crucially, in down markets like 2020, we protected capital, delivering a positive return when the market was flat. Now moving on to some of our thoughts on the current macroeconomic environment and its impact on equities. Well, it's no secret that it has been another volatile year for financial markets, dealing with geopolitical turbulence and uncertainty around fiscal and monetary policy in a number of different countries. We've moved beyond the clear bull and bear markets into what we call a kangaroo market, unpredictable and characterized by sharp up and down movements. This volatility in the global economy is especially felt in South Africa because the JSE is such a multinational exchange. When thinking about what drives our local market, it's important to remember that around 70% of revenue of companies listed on the JSE comes from outside South Africa. But this also means our market actually offers many opportunities for diversification. This year has really shown how the performance of the overall market can differ quite materially from the local economy. Returns have been quite concentrated in precious metals, particularly gold. For example, Anglo Gold, our preferred stock in the sector, is up more than 100% year to date. This really highlights the importance of being able to identify and invest in the right sectors at the right time, a key feature of our nimble approach. Importantly, that rise in gold has been partly driven by heightened geopolitical tensions that we've seen this year. For South Africa, our relationship with the US has been a key focus area for our team. While our trade terms are important, there would be a more significant impact if US investors were unable to invest in our financial markets. While the US makes up less than 10% of our total exports, they represent about 50% of all foreign investors in our financial markets. So given this kind of backdrop, what do we think will be the major drivers of financial markets for the rest of this year? Looking ahead, we see 4 key variables that matter. Firstly, continued momentum in the reforms that we've seen. Our team has heard very positive feedback on Transnet from mining executives, and we'll believe we'll continue to see no significant load shedding this year. Secondly, the global macroeconomic environment remains uncertain. Even as we see more tariff deals announced, it remains unclear what impact this will have on global growth and resources as a result. When it comes to capital flows, while foreign investor inflows haven't recovered, we think that both foreign and domestic outflows have bottomed. And lastly, the SARB. They've retained a hawkish stance, and we currently have very high real rates. We think further rate cuts are justified, given the currency strength and oil prices. Further cuts would be positive for both consumers and businesses. Just to take a step back, we think it's always important to not get too caught up in some of the challenges we may be experiencing locally when thinking about financial markets. Despite what has been a disappointing period for economic growth in South Africa, our financial markets have performed well. It might surprise you to learn that over the last 5 years, the Aussie has actually outperformed both the S&P 500 and the MSCI World Index in US dollar terms. This really underscores that there are always opportunities available, even in a kangaroo market. So how is our SA Equity Fund positioned to navigate this environment? We have a diversified portfolio across multiple drivers of return, with exposures across different sectors. Currently, we have slightly more exposure to rand hedges compared to SA Inc. equities. I'll just highlight a few positions here. We think Naspers and Prosus remain to be well supported by the growth in their underlying investment in Tencent. Absa, which has been a laggard year to date, still trades at an attractive valuation with a dividend yield of over 8% and further potential upside if the new CEO can right-size the organization. Looking at the performance of the 361 BCI SA Equity Fund net of fees, across every time horizon, from 1 year to since inception, we have delivered returns ahead of the benchmark. And importantly, we've done so with lower volatility. That really speaks to our process of consistency with an outsized focus on protecting capital during drawdowns. That brings me to the end of my presentation. I hope this has given you some valuable insights into our investment philosophy and how our agile approach can help you navigate these uncertain times. Thank you for your time.
Thanks, Zandile, for taking us into the engine room of 361's investment process. Next up, Equilibrium Portfolio Manager Thami Khoza will unpack the recent performance of financial markets and how the Equilibrium model portfolio range has fared in this environment. Spoiler alert, our portfolios have delivered exceptional returns relative to both their inflation objectives and peer groups in what has been a testing environment. Thami will also share how our portfolios are designed and positioned to successfully navigate the triple threats of slowing growth, persistent inflation, and heightened volatility in a shifting global landscape. Over to you, Thami.
Thank you, Carl, and a very good day to our valued clients, our esteemed colleagues, and stakeholders at large. We have titled today's presentation, The Triple Threat. The current investment landscape is indeed being shaped by a triple threat: elevated market volatility, persistent inflationary pressures, and a slowdown in global economic growth. These challenges, which are driven by policy uncertainty, ongoing trade tensions, and lingering supply chain disruptions, are creating a complex environment for investors seeking stability and returns. Despite a turbulent start to the quarter, investor concerns were short-lived and most major asset classes ended the period in positive territory. Let's work our way from left to right on the chart. Starting with local cash. Although yields have begun to ease following the SARB's rate cuts since late 2024, they remain relatively attractive. The STEFI Composite Index delivered a return of 1.9% for the quarter and 8.1% over the past year. South African bonds also performed well, with the OB gaining 5.9%. This was, of course, supported by a stable political backdrop and positive inflation surprises. Returns were strong across the curve, with most maturities delivering above 5%. SA equities continued their strong run, both in absolute terms and relative to global peers. The Caps Wix rose 9.7% for the quarter and an impressive 24.6% over the past 12 months. Local property markets rebounded convincingly, climbing 10.8% for the quarter and nearly 26% year on year. This recovered well after a bumpy start to the year. Turning to global fixed income, attention shifted to US fiscal sustainability concerns after the 90-day tariff pause had expired. This led to steeper yield curves across major markets. Still, global sovereign bonds held up, delivering a return of 4.6% in US dollar terms and 1.1% in rand terms, as measured by the FTSE WIGB. Global listed property also contributed positively, returning 4.8% in dollar terms, as well as 1.3% in rand terms. Global equity markets showed remarkable resilience in early April. President Trump's Liberation Day tariff announcement initially sent markets into a tailspin, with the S&P 500 falling sharply by 12%. However, sentiment quickly recovered, and the index ended the quarter up 10.8% in US dollar terms. Investor confidence returned, supported by a strong earnings season that helped mega-cap tech stocks regain momentum. The so-called Magnificent Seven led the rebound, ultimately outperforming the broader S&P 500 after a slow start to the year. Developed market equities, as captured by the MSCI ACWI, advanced 11.5% in dollar terms, translating to 7.8% in rand terms, thanks to a softer greenback. Emerging markets also performed strongly, gaining 12% in US dollar terms and 8.2% in rand terms, with Brazil, India, and South Africa standing out as key contributors. As of June 2025, South African real cash yields remained elevated, albeit off recent highs. After peaking earlier in the year, the one-year real yield has moderated but still sits comfortably above its long-term average. What this means is that cash remains a compelling allocation in multi-asset portfolios, particularly when considered against the backdrop of moderating inflation and a gradual SARB cutting cycle. Despite some yield compression, cash continues to offer real positive returns and well above the post-2013 lows. This remains a useful tool for capital preservation. Longer-dated local bonds continue to offer attractive real yields as well. As of June 2025, the 10-year real yield remained above its historical average and well within the upper bound of its one standard deviation band. What this signals is that there is compelling value for long-term investors, especially when one considers the supportive backdrop of a stabilizing fiscal narrative, moderating inflation, and improving political confidence. Relative to global peers, SA bonds continue to screen attractively on a real yield basis and remain a key component for income-seeking portfolios. The second quarter of 2025 reflected a clear story of resilience across all major sectors of the JSE. Resources delivered an impressive 9.8% return over the quarter, thanks to the strong rebound in precious metal counters, particularly the PGMs and gold stocks. This recovery came after a tough start to the year, where the sector had initially lagged its peers. Industrials continued to shine, rising 11.8% for the quarter. The sector's performance was lifted by sustained strength in rand-hedged names such as Naspers and British American Tobacco, which benefited from both global tailwinds in earnings and a relatively weaker rand. Financials also ended the quarter in positive territory, albeit with more modest gains. While trailing the other two sectors, the solid performance reflects a degree of underlying strength in the domestic economy. Looking at the 12-month picture, it's encouraging to note that all three sectors have delivered strong double-digit gains. Resources up 30.6%, industrials up 29%, and financials up 20.3%. In short, Q2 was a quarter of recovery and renewed confidence in the local equity markets. Despite early volatility, markets found their footing, helped by sector rotation, policy clarity, and improving sentiment from both a local and global perspective. When it comes to global equity markets, it's easy to believe that US dominance and passive investing are permanent features of the investment landscape. But history tells us a more nuanced story. Looking at this visual, which ranks global equity market winners by decade, we can see that no single country consistently dominates over time. While the US has been a standout performer in the 2010s and early 2020s, it was far from the top during other periods. In fact, countries like Japan, Sweden, Australia, and even Germany have all enjoyed periods of outperformance, highlighting the rotational nature of leadership in global markets. The same is true when we zoom in on investment styles and strategies. Along the bottom of the slide, you'll see that passive investing wasn't always the go-to approach. In the 1930s through to the 1970s, active strategies dominated, particularly those that leaned into value and sector rotation. Passive investing began to take hold in the 1980s and 1990s, especially with the rise of the S&P 500 and low-cost index tracking. But even then, growth versus value leadership shifted frequently. So what does this mean for us today? While passive US equity exposure has served investors well in recent decades, this chart is a reminder that diversification across geographies and strategies remains key. Leadership rotates, and relying too heavily on a single market or approach, especially one that has already had a long run, may carry more risk than it seems on the surface. Staying the course through volatility can unlock long-term growth. This chart illustrates a powerful truth. How we respond to short-term volatility can have a lasting impact on long-term growth. Both investors started with 1 million in 2005, but the green line shows the journey of an investor who remained invested throughout the ups and the downs, weathering market shocks such as the global financial crisis and the COVID-19 sell-off. The red line reflects an investor who stepped out of the market during periods of uncertainty and missed part of the recovery. By the start of 2025, the difference in outcomes was a striking 57% gap in value, or nearly 4.6 million in rand terms. The key message here isn't to take unnecessary risk, but rather to stay invested in a well-constructed, diversified portfolio, even when markets feel uncomfortable. Remember, time in the market rather than timing the market remains one of the most reliable drivers of long-term wealth creation. Let's now shift from the broader market context to how these dynamics have translated into the performance of our portfolios. All portfolios delivered solid returns over their respective time horizons, with the income, conservative, stable, moderate, and balanced portfolios outperforming their respective benchmarks. The more aggressive strategies, namely the growth and the unconstrained portfolios, faced headwinds and underperformed relative to their respective benchmarks. This was largely due to extended periods of muted returns from growth asset classes. Encouragingly, performance relative to peers was strong across the board. All portfolios outperformed their peer groups over their respective time frames, with the exception of the income portfolio, which was impacted by impairments within the MyPlan IP Enhanced Income Retention Fund. Having reviewed overall portfolio performance, let's now take a glance on the key drivers behind these results, and this is indicated by our portfolio return attributions. Over the one-year period ended 30 June 2025, both strategic and tactical asset allocation added meaningfully to portfolio performance. This reflects sound positioning across asset classes and responsive shifts amid evolving market conditions. However, manager selection did detract over the same period. This highlights areas where underlying manager performance lagged expectations despite a supportive asset allocation backdrop. From a tactical asset allocation perspective, the two most significant contributors to performance over the period were an underweight position in cash as well as an overweight allocation to local equity. This position reflected a continuous tilt away from lower yielding defensive assets towards growth-oriented exposure in the local market, where strong returns were captured across multiple portfolios. The data shows this decision added value, particularly in the more growth-tilted portfolios, such as the growth and unconstrained portfolios, where the overweight to local equity contributed as much as 25 basis points to 26 basis points, respectively, and the underexposure to local cash added up to 24 basis points. These outcomes underscore the benefits of tactical asset allocation, navigating market conditions and balancing prudence with conviction in asset class tilts to capture opportunities in a dynamic environment. From a manager selection perspective, performance was mixed over the period. While certain strategies added value, particularly within global equity and fixed interest categories, the overall impact of manager selection was a drag on performance across multiple portfolios. This was largely due to persistent underperformance from a few core holdings, particularly within local equity and fixed income mandates. As we wrap up today's session, we'd like to sincerely thank you for joining us. In a world shaped by the triple threat, elevated volatility, persistent inflation, and slowing global growth, your continued partnership, trust, and engagement mean more now than ever. To our valued clients, thank you for the confidence you place in us. To our colleagues and broader investment community, thank you for your collaboration, your insights, and your unwavering commitment to excellence. And to our stakeholders and partners, thank you for being part of the journey as we navigate complexity with clarity and purpose. We look forward to walking this path forward with you. Until next time, take care and keep well.
Thank you, Thami, for sharing those insights into our core range of portfolios. Note that these portfolios are available for investment across all leading South African investment platforms. Lastly, but certainly not least, we move to our colleague in London. Please welcome Richard Stutley, a senior portfolio manager from our London MGIM office, who will unpack the performance of our exciting core range of global hard currency model portfolio solutions that are well diversified across a range of asset classes, strategies, and highly rated global managers. Welcome, Richard.
Thank you, and thank you everyone for joining us. So we've seen, as it says there, elevated volatility driven by policy uncertainty and trade tension. But, as you may know, if you've looked at returns recently, it's not all bad. In fact, the markets rallied strongly despite all of this noise in the background. So let's go and have a look at exactly that. This is looking year to date. In fact, it's picking up. It's picking up global developed market equities, emerging market equities, developed market government bonds, and also gold. Now, gold is right at the top there, and in fact, it's actually distorting things because it's done so well year to date. So clearly one wanted to have exposure to alternatives. But nonetheless, everything else I can tell you is rising from bottom left to top right. That means all asset classes going up. And actually the return now from global equities, if you add together the developed market line, that's MSCI World, and the emerging markets line, the return together for all countries' global equities is about 10% this year to the end of June. So a very decent first half of the year for equities. And in fact, bonds haven't done too badly either. Q2, no exception, equities going up, bonds going up at the same time. Now, things going up shouldn't be a huge surprise to us. That is the natural course of things for investments if you look over time. But in the natural course of things, equities probably give you about 2% in any quarter. Last quarter, they gave you 11%. Bonds normally give you about 1%, and last quarter they gave you more like 4%. So why were asset classes quite so strong during the second quarter? I think it's actually quite hard to explain. This is picking up some of the shocks we've had this year. We look at our vertical lines. First of all, the DeepSeek news, huge disruption to the established leaders within the AI sphere. That comes out at the start of the year. Markets have to navigate that challenge. Then we get Liberation Day and the American administration saying, look, we're going to do things radically differently going forward, as it applies to trade. Again, markets have to try and navigate that. And then more recently, that final vertical line that's picking up the Israel-Iran escalation and, in fact, the bombing at times of Tehran. So very significant challenges. Another one to note, of course, would be threats to remove Federal Reserve Chair Jerome Powell. So all of these things have been there, and yet equity markets have proven particularly resilient and continue to go up. I think part of the answer to that is certainly what's been going on with the dollar. The dollar has weakened. We're picking up here the dollar against the euro, the dollar against the British pound, and also against the Japanese yen. The line there that hasn't done very much, that's the dollar against the renminbi. So that's the only area where the dollar hasn't significantly weakened this year. This helps to explain returns, as we'll see in a moment, because you've had a great currency translation effect whenever you're quoting returns in dollars. A quick note to say we don't think this represents the end of the dollar. There's all sorts of things being said about where the dollar goes from here. It's not a dramatic, we think, shift in the global order at this stage. It looks instead to us just like simple, prudent diversification. We've always preferred to have less in the dollar than most investors. Possibly other investors are waking up to that reality and doing the same as us now, and hence the dollar has been a bit weaker. I said it's had a big impact. You can see that here in all instances. The left-hand column for each of these different parts of the equity market, that's picking up returns in dollars. The right-hand column then is picking up the local currency return. And you can see how translated into dollars, you've had much better, higher returns. As I say, the dollar weakness has been our friend this year, given we prefer to invest beyond exclusively the US and dollar-denominated assets. Where do markets go from here? A couple of quick comments. We are feeling a bit cautious in the shorter term. Why is that? Well, markets have this great run since Liberation Day. So initially they fell and then they came out very strongly, and hence we have that very strong second quarter for global equities. That's the first reason I think to be cautious. You could well see a bit of profit taking. They weren't cheap going into this year either, and that's what this chart is picking up here. It's showing you essentially the price paid for equities, and that's by looking at the price and comparing that against the earnings you're going to receive. So this is the price to earnings ratio for these various markets. You can see why we're a bit wary of the US because it is the market that most clearly has got expensive or more expensive over the 10 years picked up by this chart. So as I say, markets weren't cheap. And then finally, barriers to trade aren't costless. And while there's been a lot of positive talk about where we might ultimately land in some of these tariff rates between the US and its trading partners, there is still a cost that someone is going to have to bear. Not only that, we've seen some signs of softness in the US consumer. On the left-hand side here, that is consumption expenditure, so consumer spending. And in simple terms, you can see the chart is trending down from top left to bottom right. That is consumers having less and less room to spend. On the right-hand side is picking up the housing market index, a big source of wealth for US households, as it is everywhere in the world. With that trending down, that is another source of pressure. So this is another reason to be just a little bit cautious. But balanced against that, as I've said for a while now, is the fact that we're in this high return world. At the top there, you're getting about 4.5% on a US government bond, 10-year treasury. At the bottom there, you're getting about 2% in real terms on the same 10-year debt when lent to the US government. 2%, ignore all of what's happening to inflation. It doesn't matter if it's 10%, it doesn't matter if it's minus 10%, you will get that guaranteed 2%, as long as the US government doesn't default, which I'd say is a next to zero probability. That's a decent return. And as I say, in nominal terms, it's that much higher at 4.5%. So given that backdrop, it's a good time to be invested. Rates of return are high. So overall, we're constructive on markets, but somewhat cautious just in the short term, given the run-up we saw last quarter. Okay, moving on then to the models themselves. Here is a reminder of what they are. We have the EQ Global Cautious model. We recommend if you've got an investment horizon of saying 3 years, then that portfolio may be suitable for you. If you've got a bit more time to invest, then the EQ Global Managed model portfolio, that could be more suitable, and so on. With an investment time horizon more like 7 years, so you've got a bit of time to put your money to work, then the Equilibrium Global Growth portfolio could be more appropriate. Now, I should also say around these 3 multi-asset models that I'm talking about today, we have other investments. If you don't have 3 years, you need something a bit shorter. Well, we also have investments that may be suitable for that. If you're less interested in multi-asset at the other end of the spectrum and instead just want a pure equity portfolio, well, we have a whole range of solutions that may cater for that. So as I say, if you're interested in these 3 multi-asset models, or indeed if you've got a slightly shorter term need, or indeed a need for pure equities, then please just reach out to whoever your relationship manager at Momentum is, or indeed come and find me, and let's have that conversation about how we can solve for what you're looking for. So those then are the models. Do they work? I always show this chart. This is looking at since inception of these models, how they've done versus the cash plus targets that we've set them. Remember, each of them is looking to outperform, to work harder than a pure allocation to global developed market currencies like the dollar, the yen, sterling, euro, those kind of things. So you want to see your money working harder than those investments. In the case of cautious, we're looking to outperform global cash by 2.5% per annum. Managed, that rises to 4%. And with growth, you're looking to get an extra 5.5% in excess of global cash from investing in that strategy. Can we deliver those kind of returns? Those are quite meaningful margins that we're looking to outperform cash by. Well, here is the evidence since we started managing them, and it shows that yes, we can. All of the lines are ahead of their corresponding target. Those are the dotted lines, and that indicates that they've worked. So if you're looking for offshore exposure, if you're happy to take a little bit more risk, and for that to see your money work harder and generate higher returns than just an allocation to, say, dollars, then these could be one option to think about. We look then at the quarter. It was a really strong quarter, both in terms of the actual the numbers, the returns we produced, but also how we tracked versus the reference rates, which we always look at in these videos each quarter. So there you go, Equilibrium Global Cautious doing 6.3% in the second quarter. That's a very high return for any 3-month period. It's higher then in the case of managed at 8.7%, and it's higher again in the case of growth at 11.2%. And as I say, so these are decent numbers. That's decent growth in one's portfolio. How does it compare against sensible targets? Well, against the targets we'd set, those global cash plus reference rates, we did much better than those. If you take cautious, the portfolio did 6.3%, global cash plus 2.5%, that would have given you the lower 4.9%. The other area we want to look at is peers. You could, of course, have owned a different model. How would you have done if you'd chosen to do that instead? Well, again, we've done much better than those models. In the case of cautious, again, because it's at the top, peers gave you the lower 4.3%. So a good 2% behind where we were. If you look over the 1 year, that good return in Q2 this year, it just builds into a very decent return over 12 months. So double-digit returns and getting close, in fact, to 20% in the case of Equilibrium Global Growth. So very decent returns in the short term. Looking in a little bit more detail at what happened during that quarter, and we're going to take Equilibrium Global Managed. So its return is shown on that leftmost column. And what am I comparing it to here? I'm comparing it to a simple 60-40 equity bond portfolio. And you can see that that did a pretty similar amount. So good returns, better than cash, better than peers, but in fact, pretty much on par with a 60-40 simple benchmark. What worked for us? Well, if we move towards the middle of this chart, you'll see manager selection worked for us. That was positive. Asset allocation, we'll see in a moment, that didn't work entirely. That was slightly negative. You deduct fees and you get to a very slightly positive alpha for the quarter. So to say, here's asset allocation. It actually detracted 0.6%. What happened there? Well, simply put, we were too defensive. We had too much in cash. That was the biggest detractor. As you can see, it cost us minus 0.4%. We were about 5% overweight cash in Equilibrium Global Managed. And while it was positive cash, it gave you 1%. That really wasn't enough during a strong up period. So as I say, the takeaway is we were too defensive in Q2. Do I think we should be changing that? Well, I spoke a moment ago about being cautious in the short term. I absolutely don't think we want to be changing that today, given the big run up in markets in Q2. So I'm comfortable with where we are. It didn't hold us back too much. And that's because manager selection was very decent. So manager selection contributed 0.8% over the quarter. The biggest contributor therein, it was pretty broadly shared across our managers, but the biggest contributor came from Coronation with their Global Emerging Market Equity Fund. Coronation outperformed by nearly 5%. That's the third column. They delivered a return of 17%. EM equities did more like 12%. Therein, your 5% outperformance. And where did that come from? Well, the biggest contribution to their outperformance came from stock selection in Brazil, also in China with names like Tencent. So good manager selection overall. The biggest part of that came from Coronation. Back to returns then, I spoke about the last quarter and the last 1 year, so that's pretty short term. Longer term returns are very decent. So if we look over 3, 5, 7 years, it's in fact the case for all the numbers shown here over all these time periods. We have these 2 reference rates for each of the model portfolios. We want to be beating those. I can tell you that as at the end of June 2025, over all these time periods, we are beating all of the reference rates across all of the 3 profiles. That's where we want to be all of the time. It won't be the case that we're there all the time, but it does show that by sticking to what we do and having conviction, we can deliver decent longer term returns. With that, I think there we go. We have some important notes. We then have more important notes, it seems. And all that's left therefore for me to say is a big thank you for your time again this quarter. I look forward to connecting soon. Thank you.
Thank you for the great insight into performance and positioning of our global model portfolio range, Richard. And that wraps up our quarterly bulletin for the day. We know how valuable your time is and would like to thank you for supporting our solutions and for joining us today. We hope the insights gained from this webinar will be valuable to both you and your clients. Please don't hesitate to reach out to us if you have any further questions or require any assistance in further integrating our solutions into your advisory practice. Our team of investment specialists and portfolio managers stand ready to help. Until next quarter, goodbye and take care.